Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we're going to make the best investments that we can, so thank you so much for joining us. On today's show, we have Bret Jensen. He's back on the show, and he's going to give us another update on all the important and newsworthy events going on in biotech space right now. So this is a September edition of everything you need to know about biotech right now. We're going to talk about the interesting ride that biotech has been in over the recent months, what the sector really needs in order to move forward at this point, an update on the latest biotech and pharma witch hunts going on with the government and otherwise, what to expect from the sector after the presidential election, updates on overall merger and acquisition activity and what to look for, why Pfizer and Allergan could make some big moves in the near future, why Gilead is under big pressure and what they may do about it, what his two prime targets are for being bought out. Two prime buyout targets are at this point is what I should say. And thoughts on what will likely happen regarding a rate hike and the big mistake that so many biotech investors make. All that and more in this show. So thank you so much for joining us with this interview with Bret Jensen. And we're offering a new feature to the show, as I mentioned a few times already. If you're out on a jog or you're in your car and you're listening to the show and you're thinking, man, I wanted to remember this later on or I missed something, then I'm offering a summary sheet of all the show highlights sent to you. This is not simply a preview sheet, but my actual notes that I take during the interview for all the key ideas. If you want these notes, simply text the word, one word, family notes. That's family notes, one word, to the number 44222, or visit investorinthefamily.com and sign up, and we'll get you taken care of there as well. Remember, our goal is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com or subscribe to the show at iTunes and Google Play. How much time do you currently spend trying to figure out your investments? Are you tired of spinning your wheels, attempting to conduct research that you really don't have time for? And if we're honest, you might not actually be qualified to do. Bret Jensen is the man behind the Biotech Forum, the number 2 premium marketplace service on Seeking Alpha. He's also a top 5% ranked analyst according to TipRanks. Do you like owning companies that get acquired? So does Bret. Are you anxious about the current election season and how it may impact your portfolio? Perhaps it's time you put a portion of your portfolio on autopilot with Bret as your guide. Visit biotechforumsa.com for more information. That's biotechforumsa.com. SA as in Seeking Alpha, biotechforumsa.com. And hope you enjoyed today's interview with Bret Jensen. Well, hey, Bret, welcome back to the show.
Brian, thanks for having me again.
Well, man, it's always an honor to have you, and no real introduction needed for you and your background in biotech. So I'd love to let's just dive in, and I'd love to hear what's on your mind, biotech right now, what's going on in the space.
Well, biotech has had a very interesting ride over the last few months. As most biotech investors know, starting early last summer, the sector dropped almost 40% from peak to trough. Seemed to have bottomed in the first quarter of this year, kind of rolled along those levels for a few months, then had an explosive upside in July, up almost 20%. Probably the best performing large sector in the market. August, it had a steady, consistent decline, about 60%. Very orderly, which one might expect after a huge gain like that. There's some consolidation. Canada basically been a relatively narrow trading range for a very high beta sector of the market here for the last 6 to 8 weeks. Most of the market had low volatility until Friday, where the S&P and the NASDAQ dropped a little over 2.5%, small caps, and the biotech sector dropped about 3%. And shockingly, some of the low beta sectors, the high yield sectors such as consumer staples and utilities, just got slaughtered. Utilities was down almost 4% on the day, which is that's almost a monthly move for that sector. I think both of those are very overstretched. Biotech's already had its bear market, so I'm a little less worried about that. Luckily, the market rebounded today, September 12th. Biotech almost recaptured all its losses on Friday, but was still kind of in a range. I think that, part of what the sector needs to go ahead and move forward is kind of a twofold. Number one, it needs this election to be over. The political overhang has been on it since last summer with the focus on drug price gouging, Mylan, was up before Senate subcommittee last week. And around its pricing on the EpiPen, which seemed to have caught the media attention. I think that'll be the last little witch hunt we have before now an election. And I think the sector should be very well after the election, simply because if you look at the polls and the most likely probabilities, we're going to still have divided government come when Congress and the new president gets seated here in January, which means no major legislative change is going to happen on either the pharma or the biotech sectors, and it can start trading the way it should trade. The large cap biotech concerns collectively, as far as valuation, are going for their lowest level compared to the overall market in over a decade. So I think looking at 2017, I would expect both pharma and biotech will be very strong performers in the market. The other thing that we need to come back to get the next leg of the rally is an uptick of merger and acquisition activity. That always ignites the animal spirits in the sector, especially the small and the mid-cap concerns. Medivation was probably the biggest purchase target over the last 3 or 4 months. It was purchased by Pfizer for $14 billion. Late in August, they had to outbid the French drug giant Sanofi. But before that acquisition, M&A deal volume was down a little over 64% year to date compared to the same period last year. Now, Pfizer's already gone ahead and got a lot more active in the merger and acquisition space here since the Treasury Department derailed their mega merger with Allergan in late April. They purchased Medivation for $14 billion. They purchased Anacor in May for $5.2 billion, and then they made a small purchase of the antibiotics division from AstraZeneca, which could total about $1.75 billion. Now, I would expect Allergan, the other side of that mega merger that was derailed, to start being much more active, especially in the small and mid cap space. They just completed their sale of the generics business to Teva Pharmaceuticals for some $40 billion. Now, the company has said they'll take about $10 billion of that and buy back stock, but they're very interested in making small or bolt-on acquisitions in 4 key areas, including eye care and gastrointestinal. So I expect them to be a very active member of the hunters within the space. In addition, Gilead Sciences, which has had two huge franchises as far as HIV and hepatitis C. Their sales are starting to decline on the hepatitis C front, and they've had a lot of pressure from both analysts, investors, and if they don't do something soon, probably activists, to be much more aggressive in the M&A space. So that's another player. Obviously, Sanofi is probably going to be looking around as well. They've been a bridesmaid a couple of times in the last year. They lost out to GS Pharma in November last year to AstraZeneca for $2.7 billion. They just lost out in Medivation. And they have some of the same problems a lot of the large pharmas have, and they're just not seeing any kind of growth in their pipeline. A lot of stuff is coming off patent. They haven't developed any kind of new blockbusters in some time. So they're definitely going to be looking for some small and mid-sized companies to digest. Now, thanks to the Treasury Department, I don't think any huge mergers are going to go ahead and take place until at least after the election, probably not until everything gets sorted out in January next year. So I think the action, quote unquote, is going to be in the small and the mid cap space. 2 names that I think make prime buyout targets here. One is Acadia Pharmaceuticals, ACAD on the NASDAQ. It has a market value close to $4 billion. In the second quarter, they had their first drug approved, and that was the first treatment approved for the psychosis that often accompanies Parkinson's disease, which unfortunately about 1 million people have in this country, about 400,000 that actually have the psychosis associated with Parkinson's. That's probably $1 billion indication. And they have it also, that drug Nuplicid is in the testing, mid-late stage testing for both Alzheimer's and schizophrenia. Those two indications are going to be very tough to go ahead and show demonstrable impacts where that could lead to approval. But in this space, neurology, what will happen is a lot of doctors in that space will experiment, and if they see a reduction in psychosis in those indications, they'll start prescribing off label. So I think they're going to get sales from that, whether the FDA approves it or not. The problem they are going to have, of course, is that they've been strictly a developmental firm for all these years, getting their first drug to market, and now they have to build a sales force. Now they got more than enough cash on hand with about $600 million to go ahead and do so. But this is usually the transition point where you see a lot of the mergers take place in biotech. A very logical acquisition partner for Acadia would be Biogen, which is a much larger concern, number one. Number two, already has a sales force in neurology. And number three is spinning off its hemophilia business for about $5 to $7 billion to expand their footprint into neurology. Another company that's been mentioned as a possible suitor is Merck. The other stock that I think that makes a prime acquisition target, and it's a little smaller, is Portola Pharmaceuticals, PTLA. They're a little over $1 billion market cap. They've run into a bit of a hiccup as far as getting their first drug approved, called Andexxa. This is a antidote to the new kinds of anticoagulants such as Eliquis and Xarelto. Going to be a big niche product. They got a complete response letter from the FDA late in August that knocked the stock down about 30%. It's come back quite a bit, simply because investors realize that the concerns outlined in the letter aren't around the drug itself or its effectiveness. It is around the manufacturing process. And based on some recent CRLs of the same ilk, it's probably going to take anywhere from 2 to 4 to 5 months to resolve, but they should be on their way to approval by the end of the year. They're very much like Acadia, and they've been strictly a developmental concern, and now they're going to be a commercial focused concern. That's always a tough transition. In addition, the management's kind of drawn the ire of some investments and some analysts simply because they didn't really have their I's dotted and their T's crossed as far as getting through the FDA process. A more experienced team probably wouldn't have ran into the manufacturing issues and would already had the drug approved. So that I wouldn't be surprised if that gets bought out, either from one of Pfizer would be a perfect acquisition partner. Number one, they were active. Number two, all the industry players want the antidote. Some 80,000 people a year go into ERs, and having a universal antidote to the new anticoagulants when problems occur is good for the entire industry. So that's another one that I think would, if it's bought out in the next 6 to 12 months at a good-sized premium, would not surprise me at all. Other than that, we're basically just kind of waiting for, some sort of direction to the market. We're kind of listless right here. I think a lot of the market's waiting for election pass. We're also waiting for hopefully the GDP to pick up in the second half of the year because there's really just no growth as far as earnings or revenues right now. The S&P 500 has seen 5 straight quarters where profits have declined on a year-over-year basis. Ironically, this is one of the reasons I think some of the larger biotech concerns and pharma concerns will be very strong in 2017 after the elections, because two of the few industries within the economy that is showing very strong revenue and earnings growth despite a very challenging global backdrop.
Do you think there's anything to the? You can't go very long without someone talking about rate hikes. Do you think there's anything to, like, for some reason, the talk of rate hikes right now, and again, this is mid-September 2016, people are getting really excited about it again. Do you think there's anything to that at all?
I think there's probably some powerful positives, or not positives, probably reasons the Fed would probably like to hike rates. Unemployment on the surface is low. They really haven't followed up from their direction at the start of the year where they're going to have 4 interest rate hikes. They want to show they have independence. However, I think the blip in the market last week was the Fed jawboning a bit, where you have kind of different opinions within the voting members of the Federal Reserve. I just don't see Chairwoman Yellen really wanting to raise rates right before a very contentious and a very close election. It's better to go ahead and jawbone those rates up. And if you're going to hike, you're going to go probably do it in December. And even if they do it then, which it's probably right now, the future is about a 60% probability, they're probably one and done. I just don't see how they can have a sustained series of rate hikes when you have the European and Japanese central banks pursuing negative interest rate policies, because that would cause the dollar to appreciate to such an extent it would start to impact economic growth, S&P profits. Obviously, it started becoming a political target as well. So if we do get a rate hike, it's going to be 0.25%, and that might be the last one we see for a while until global economic growth picks up to a decent degree. And it's really hard to see what's on the horizon or cause that to happen.
Yeah, it seems like it's kind of the dance you just get tired of. Like how many times can this conversation happen and then nothing happen? We had the 1 rate hike, obviously, but no, I would just, and
we had the reaction to that.
Exactly.
And that's the Fed's really worried about. To me, the whole quantitative easing is kind of like pushing down completely on the gas pedal. Well, that's great when you're in a straightaway, but when you have to start applying the brakes around the curve, that's when you find out whether you can go ahead and manage it or not. And we're just have not been to the point where the Fed's willing to do that. And every time they make noises on it, the market starts to fall apart, which really tells me how dependent the market has become on the central bank, because we're not seeing the fiscal reforms or the stimulus needed to go ahead and get us off this 2% GDP growth we've been mired in for 7 years now. And we're actually better than the rest of the world.
No, I'm with you. That's helpful. Yeah, you mentioned some of the things as far as affecting biotech and as far as direction from the markets and hoping for GDP to pick up. It's hard to have that conversation without somehow factoring in rate hikes, because that's obviously big on everyone's mind. So I'm glad to hear your thoughts. I mentioned before the interview, like there's a couple companies that have been on my mind that I've heard from different places and been curious about. And I'm curious of your thoughts, and I'm putting you on the spot. So if you don't have intel on at the moment, that's totally fine. But one of them you did mention was Teva Pharmaceuticals, which may be a relatively boring company, not one of the more exciting ones within focusing on generic medicines. But do you see that as a good growth opportunity over the next year or two?
I think I own Teva. It is a good, solid, long-term, large-cap core position. It's a single, and which in a market in a single is very good here. It's cheap as far as valuation. It'll get some economies of scale, integrating Allergan's a generic business. It pays a nice dividend. It's a very solid. It's not going to double or even go up 30 or 40% in the next year. But with the dividend, 10 to 20% seems more a reasonable probability. A solid company. Mylan's another one I would go ahead and look at as well. It doesn't pay a dividend. Obviously, they've been in the news for the wrong reasons. But it does have technical support here right at 40. It had a good day today. It's selling for less than 8 times next year's projected profits. The EpiPen is important to them as it's their biggest product, but it's still less than 10% of their sales. It's much bigger as far as the profit margins, but those revenues are not going to go away completely. So I think that's a good solid core position as well. 2 years from now, I don't think anyone's going to remember Mylan was before a Senate subcommittee. And early in 2015, remember that Teva offered to buy Mylan for about $85 a share, and Mylan actually bought a company called Meta for about $10 billion in Europe that's going to help them grow into the emerging markets like China and Russia. So they're a bigger entity than where they were when Teva was willing to pay $85 for them. They're now selling at $40. And nothing really has changed long term on their business model.
Wow. What about Exact Sciences?
Exact Sciences is interesting. That's really not my space. I'm more of the development or pharma and the biotech compounds, not so much the testing side of things. That's not one I really follow very closely. I know that Jim Cramer was very high on it when it was much higher. I really try to stay kind of really based on what I know well. So I'm aware of it, but I really don't have a solid opinion one way or the other on it. One of the things that I think biotech investors always make a mistake of is they always follow the hot trend, and pioneers tend to get arrows in them. So over a decade ago, it seems like every other biotech firm had to do with stem cells. And some of these things went up 500 to 600%, and then they crashed. And the poster child of the whole thing was a company with the ticker STEM that got up to 65 and just got sold out for like $1 a share. And then 2 years ago, of course, everything was immunotherapy or CAR T. You had, the Kite Pharma, Juno, Zeopharma, Bluebird Bio, all going up 3, 4, 5, 600%. And of course, when the reckoning came, it was pretty disastrous. The new thing is going to be gene editing, and that comes back to the whole Illumina thing. Now they make the equipment; they're going to be like picks and shovels kind of play there. But some of the new ones like Editas, which had one of the few good IPOs, and it's a quality company. But it wouldn't surprise me that gene editing becomes the new fad in biotech over the next 6 to 12 months, because it's already been kind of tabbed. This is how we're going to go ahead and take biotech to the next level. We're going to solve all the diseases of the world. And it seems very familiar to stem cells and immunotherapy. Right. There are going to be winners in the space, but I'd be very careful if this starts to run, because that almost always ends the same way.
It's like getting into 3D printing a few years ago.
3D printing, another great example, or the internet boom where we valued companies by eyeballs instead of cash flow.
What's wrong? What was that? Did that not turn out good? Was that a bad ending there?
Well, it's interesting because every time you have one of those huge, euphoria, you always have some great companies that come out of there, like Amazon, perfect example, right? But you also, for every Amazon, there's the web bands, the pet.com that, it's kind of becomes trivial questions. Where are they now? They're bankrupt,
Right. Well, hey, Bret, this has been a gold mine as always. Thanks so much for giving us some time, especially on your birthday. Everyone listening to this, it will not be your birthday when they hear it, but I know it's your birthday. So happy birthday. And thanks so much for spending some of it with us here today.
Brian, thanks so much for having me, and thank you for the birthday wishes.
I hope you enjoyed today's interview with Bret Jensen. Remember, you can get full show notes with links and other details at investorinthefamily.com. Don't forget, you can always subscribe at iTunes, Stitcher, or the Google Play Store. And if you want to receive my summary sheet highlights from all the big things from the show, all the important details, simply text the word Family Notes. That's one word, Family Notes, to the number 44222, or visit investorinthefamily.com and sign up, and we'll make sure and get you set up. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.